called in, it's usually pretty obvious that it's about to, that I'm going to be called.
Mic check, 1, 2, 3, mic check, 1, 2, 3.
All right, good morning. The Subcommittee on Oversight and Investigations will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of Silicon Valley Bank and Signature Bank, GAO's Preliminary Review. And without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for the inclusion in the record. I would like to take 5 minutes here for a brief opening statement. Congressional oversight is a constitutional authority used to maintain the well-being of our system of government. This is a lesson that I learned from my fellow Congress.
Timer's not moving.
Sorry, we've got to make sure we get the timer going. There we go. Well, this lesson of oversight was something that I learned from someone who was considered the lion of the House, John Dingell. He was still in Congress when I first came here, and he taught me a couple of things. One, he called it the tyranny of the vote. It didn't matter who you were with, what you were doing, what was happening, or where you were. When they rang the bells, we had that time to go to the House floor to vote. The other was our constitutional standing, our obligation, frankly, of oversight of administration. And he was an expert at that. Didn't matter what the party label was. He always fought for the standing of Congress. Well, the GAO office is, the Government Accountability Office, is an investigative arm of Congress. They provide fact-based, nonpartisan information that can be used to improve government and save taxpayers billions of dollars. Committee Republicans and Democrats should support robust oversight of our financial regulators, aiming to seek transparency and demanding that accountability. Unfortunately, as you will hear in today's testimony, regulators in Washington are attempting to paint a bit of a different picture, but the facts are clear. The collapse of SVB and Signature Bank were the result of risky business strategies, no doubt, and years of failed supervisory action. In fact, some of the concerns identified in GAO's April report are now not new. In 2013, a report titled Financial Institutions, Causes and Consequences of Recent Bank Failures, the GAO highlighted that aggressive growth strategies using non-traditional, riskier funding, similar to those of SVB and Signature, were key factors in bank failures. These uninsured, unstable deposits accounted for much of SVB and Signature Bank total assets, which the FDIC noted in 2019, quote, could pose risks to regional banks, close quote. SVB was also affected by rising interest rates, which was fueled by reckless spending in the Federal Reserve that was too late to react. In 2015, GAO report on bank failures concluded that the regulatory process was not always effective or timely in correcting the underlying problems before these banks failed. In the years prior to their collapse, the Federal Reserve and the FDIC identified management risks at both banks, yet allowed those risks to go unfixed. The failure of federal regulators to mitigate or escalate management concerns proved costly. While the GAO's report that examines Treasury's use of the systemic risk exception, the SRE, and the establishment of the Bank Term Funding Program. Particularly, the use of the SRE is a powerful emergency tool, and that has not been without criticism. In part of our investigation into the government's response to these bank failures, the subcommittee hopes to better understand how the Federal Reserve and the FDIC concluded that that recommending use of the SRE was the last resort. Again, the GAO has previously reported that use of the systemic risk exception, quote, may weaken market participants' incentives to properly manage risk, close quote. While the Treasury Secretary has warned the public not to assume these actions create a guarantee of deposits, it's hard, frankly, to think otherwise. Ultimately, whatever losses to the Deposit Insurance Fund will be passed down to hardworking Americans. Frankly, any loss in confidence in our banking system is a loss in confidence of our regulators. Regulators had the tools at their disposal to prevent these bank failures from happening, and they missed it, period. And instead of concentrating on the basics, the things that they didn't get right, some of my friends on the other side of the aisle want to give our regulators even more complicated rules. As the Biden administration and the Federal Reserve attempt to shift the narrative, the GAO's report provides no evidence the failure of SVB or Signature Bank were the result of relaxed regulations. I believe it necessary to reiterate how important it is that this committee receives the information that has been requested and the information we will be requesting moving forward. The American people deserve answers. We should not allow history to be rewritten, and I welcome the FDIC and the Federal Reserve to appear at future subcommittee hearings to further answer our questions. I'm committed to making sure this subcommittee doesn't just draw conclusions, but bases its findings on evidence. That is what oversight is, and as chairman, that's my commitment to our members. So I look forward to hearing from Director Clements, and I yield back the balance of my time. And with that, the chair now recognizes the ranking member of the subcommittee, the gentleman from Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I commend the prompt response of President Biden, Ranking Member Waters, and federal regulators to the failures of Silicon Valley Bank and Signature Bank. This collective judicious response, led by President Biden, prevented extensive contagion, protected depositors, preserved the integrity of our banking system, among many other things. The rapid collapse of these banks revealed how quickly bank runs can occur in our increasingly connected world. Although fingers will be pointed at technology, President Biden and regulators as factors in the failure of Silicon Valley Bank and Signature Bank, they were not not the root cause of banks' failures. The focus of today's hearing should be the mismanagement of these banks by their executives in the years leading up to the collapse, in tandem with the Trump-era deregulation that enabled this mismanagement to fester. Both Silicon Valley Bank and Signature Bank experienced outsized growth between 2018 and 2022. Signature Bank grew from approximately $47 billion in total assets in 2018 to $110 billion in 2022. Silicon Valley Bank increased from $56 billion to $209 billion over that same period of time. Mr. Chairman, some things bear repeating. Silicon Valley Bank increased from $56 billion to $209 billion over that same period of time. This outsized growth in assets was fueled by more than 70% uninsured deposits at both banks, far higher than the median of 32% for comparable banks. The executives at both banks knew or should have known, they knew or should have known that their risk management practices had to be strengthened appropriately as they grew exponentially. Adding insult to injury, Mr. Chairman, Silicon Valley Bank irresponsibly operated without a chief risk officer from April until December of 2022. Is it a coincidence, I ask, that these banks grew rapidly beginning in 2018 and failed to adequately manage their risk around the same time that former President Trump signed S-2155, his bank deregulation bill, into law? S-2155 diminished regulatory standards on these mid-sized banks, resulting in much less enforcement security. Friends, blaming President Biden and regulators won't reinstate stronger regulations on mid-sized banks or promulgate needed legislation to enable lawful clawback of ill-gotten mismanagement executive compensation. Only legislation can do this. I want to thank you for the time, and I want to ask the Ranking member of the full committee, if she desires time.
Thank you very much,
I
Mr.
yield
Green.
to the ranking member.
The gentleman yields.
I thank the GAO for the preliminary review it issued at my and Chair McHenry's request on the failure of Silicon Valley and Signature Banks. The GAO has clearly described how the FDIC and the Fed repeatedly informed these banks as early as 2018 about deficiencies in their liquidity and risk management. Instead of taking action, these banks ignored the warnings. Let me be clear. Regulators need to be more aggressive, something I've long been demanding with regard to repeated abuses at Wells Fargo. However, it was the responsibility of the banks first and foremost, to swiftly and thoroughly correct the deficiencies that were flagged by regulators. We now need to hold banks and their executives accountable, reverse Trump-era deregulation, enhance supervision of banks, and reform deposit insurance. Thank you, and I yield back.
The gentleman yields back. Today, we welcome the testimony of Mr. Michael Clements. Mr. Clements is the director of GAO's Financial Markets and Community Investment Team. He leads GAO's work in overseeing the financial markets and their regulators. Mr. Clements led the team responsible for preparing the interim report issued by GAO 2 weeks ago on the March 2023 bank failures. Since 1999, Mr. Clements has contributed to the mission of GAO in supporting congressional oversight efforts over the regulation of the financial banking regulators and previously the broadband communications and telecommunications industries as well. We thank you for taking your time here today, sir, and you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statements will be made a part of our permanent record. So, Mr. Clements, you are now recognized for 5 minutes.
Morning, Chairman Hosanga, Ranking Member Green, Member Waters, and members of the subcommittee. I'm pleased to be here today to discuss GAO's preliminary work on the March 2023 bank failures as reflected in our April 28 report to the committee. As you know, at the time of their failure, Silicon Valley Bank, or SVB, and Signature Bank were the 16th and 29th largest banks, respectively, in the country. Their failures could impose a $22 billion cost on the Deposit Insurance Fund. While not part of our work, First Republic's recent failures could impose another $13 billion cost on the Deposit Insurance Fund. For today's hearing, I will focus on 1, bank-specific factors that contributed to the failures, and 2, supervisory actions regulators took leading up to the failures. First, the bank failures. We found that risky business strategies and weak liquidity and risk management contributed to the failures at SVB and Signature Bank. SVB and Signature both experienced rapid growth, far exceeding a group of 19 peer banks. For example, SVB's assets more than tripled in the 3 years prior to its failure. SVB and Signature also relied heavily on uninsured deposits, which are prone to run risk. For example, Signature funded 82% of its assets with uninsured deposits. SVB and Signature also exhibited weak liquidity and risk management controls. When confronted with external pressures, rising interest rates for SVB and weakening digital asset markets for Signature, the risky business strategies and weak management contributed to the bank's failures. Second, the regulators' supervisory actions. We found that the regulators identified problems at SVB and Signature Bank, but the regulators did not escalate supervisory actions in time to mitigate the risk. Federal Reserve staff who examined SVB and FDIC staff who examined Signature identified problems at the banks. For example, between 2018 and 2022, the Federal Reserve issued 10 matters requiring attention to SVB for liquidity and risk management problems. Likewise, FDIC issued matters requiring board attention and other supervisory recommendations to Signature for similar problems. However, we found that the Federal Reserve and FDIC did not adequately escalate their supervisory actions. The Federal Reserve was generally positive in ratings of SVB from 2018 through June of 2022, rating SVB's overall condition as satisfactory. When SVB moved from the Federal Reserve's regional banking organization, examiners began downgrades. Yet, despite the consistent liquidity and serious management problems, the Federal Reserve did not issue an enforcement action before the banks failed. Likewise, FDIC's ratings of Signature Bank found its overall condition was satisfactory from 2018 through 2021. FDIC staff told us they were considering escalating supervisory actions in 2022, including taking enforcement actions. However, despite Signature's repeated failures to remediate the liquidity and management problems, FDIC only issued enforcement action the day before the bank failed. GEO's reported similar findings in the past. In 2015, we reported that although regulators often identified risky practices, the regulators' process was not always effective or timely in correcting the underlying problems at banks.
Mr. Clements, I'm so sorry. We've just gotten notice that they're having a difficult time hearing you through the audio, and because this is being televised, if you could just pull that a little closer. We can hear it all well here in the hearing room, but apparently just not through television. So if just pick up where you're at. That's
right.
That's helpful. Thank you. Sorry about that.
So in 2011, following the financial crisis, we recommended that the regulators consider adding non-capital triggers to the prompt corrective action framework to help give more advanced notice of deteriorating conditions. And in 1991, following the savings and loan crisis, we found that regulators did not always use the most forceful actions available to them to correct unsafe and unsound practices. We continue to believe taking early action would give regulators and banks more time to address deteriorating conditions. Chairman Huizenga, Ranking Member Green, and members of the subcommittee, this completes my prepared statement. I'd be happy to respond to any questions you may have.
Thank you, Mr. Clements. We appreciate that, and we will turn now to member questions, and the chair recognizes himself for 5 minutes for questioning. Again, Mr. Clements, thank you for testifying before our subcommittee today here. The work you and your team have done to complete the preliminary report so quickly is much appreciated. Your report is the only impartial review, frankly, conducted on these bank failures, in my estimation. And I'd like to start by setting the stage a little bit, starting with how the preliminary review was conducted. I understand that you conducted interviews with staff from the Federal Reserve, FDIC, and Treasury. Can you talk to us about how those witnesses were identified for you to interview? Did you do that on your own, or how did that work?
The standard, we had one meeting with each of those entities. Our standard practice is to send our list of questions over to the agencies, and then the agencies will identify staff who are best positioned to answer those questions. Typically in follow-up work, which we do tend to complete with this, we'll be more specific in asking for particular individuals to speak with. So in the case of the Federal Reserve, we met with board staff in the Supervision and Regulation Division, and also with staff from the Federal Reserve Bank of San Francisco.
And then, did you feel like you had full access to agency staff? Were you able to do follow-up with those folks as they were getting back with some of these answers? You said you had passed those questions along. They self-identified who would be best to answer those. Were you able to interview those folks and do some follow-up?
At this point, we just had the one meeting with the three agencies. Again, moving forward, we will have further meetings with them.
Okay. So were they in person?
They were not. They were virtual.
They were virtual, so they were not in, okay. And then do you know that the interviews that you conducted, were there multiple people on at the same time, or was it with one individual?
These were hour-long meetings with the entire staff that the agencies had identified for us.
Okay, so it was kind of a whirlwind. You had everybody on the screen doing this Zoom?
It's what we refer to as an entrance conference.
I'm sorry, a what conference?
An entrance conference. It's our preliminary initial meeting with the agencies to go over what our work is going to be and some preliminary questions that we have for them.
So in other words, you were planning on doing follow-up?
We do plan additional work once we moved beyond getting the April 28th
This
report out.
preliminary
Correct.
report, okay. And did you feel like the regulators provided you with access to all of the documents and the material facts that you had requested in a timely manner? What was the turnaround time from these requests that you sent in to when you were actually doing these Zoom interviews?
The agencies were responsive in getting us the desired information. We had requested a variety of supervisory information, scoping memos, schedules, records of exams, supervisory letters. We received all those, I would say, within probably 3 or 4 days. I know the Fed staff was working over the weekend to get us that information. So we actually did appreciate the timeliness for this engagement. I think they recognize the importance of this work.
I'm glad to hear they're responsive to somebody in this, because we've got a number of letters that have been out that are lacking that response, frankly. So now I'd like to pivot and ask about something specific in your report, or rather something that was maybe not in your report. GAO is in a position to provide sort of a unique historical perspective on bank failures with other economic events from the past, because you have done some of these reports in the past, correct, on previous challenges?
That's correct. We
Yeah.
go back to 1991. Actually, I think 89 might have been our first work looking at the savings and loan and community
Okay.
bank
Yeah, savings
challenges.
and loan failures that were then. All right, in contrast to the GAO report, the report issued by the Federal Reserve partially blames the failure by Fed examiners not escalating SVB's liquidity and interest rate risk concerns quickly on, quote, and these are your words, their words, a shift in culture and expectations that changed how supervision was executed, close quote. From what you saw, was a culture shift referenced in any discussions that you had with the Fed staff or any of the documents that you reviewed over the course of compiling your initial report?
Yeah, I have no basis to say whether there was a culture shift one way or the other. Again, we had the single meeting with the Fed. The issue of culture wasn't brought up. In fairness, we didn't ask it, but they did not bring it up either.
Okay, but it features prominently in their report that there was this culture shift. It seems a little odd to me that they would not have brought that up in your investigation. All right, to your knowledge, was a culture shift mentioned in any past GAO work on similar bank supervision issues in 1991 or 2011 or 2015 or 2019 when you've done some of these other reports?
I'm not aware of there being a cultural change. We've previously reported that in general, examiners in the past have taken a cooperative and formal approach with agencies, and that's been as early as 91.
All right, my time has expired. We're going to be sending you some additional written questions from me as well regarding the FDIC and trying to make sure that we understand the process for both SVB and Signature Bank. So with that, I will recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Mr. Clements, when I served as chairwoman, I investigated the egregious pattern of consumer abuse at Wells Fargo and found that regulators failed to use escalating enforcement actions to correct the bank's bad behavior, even as new and similar abuses emerged. I have legislation that would require the bank regulators to impose limits on bank growth, divestment, and other penalties for noncompliance. That is why I'm pleased to hear that regulators like the CFPB and OCC are beginning to focus on ways to ensure that repeat offenders correct their bad behavior. According to the GAO report, the Federal Reserve and the FDIC have been advising Silicon Valley Bank and Signature Bank about the weaknesses in their risk management and liquidity programs in multiple examinations since 2018. Now, Mr. Clements, from your review, did the banks receive adequate explanation and information from the regulators to know that they had problems and what those problems were and what was needed to fix them?
We certainly saw numerous instances of matters requiring attention, matters requiring board attention, matters requiring immediate attention. that laid out issues, and we focused on the liquidity and risk management because that was sort of the proximate causes of the failures. We didn't go on the various other consumer angles as well. But we have in the past reported that the communication, the clarity, and some of the of supervisory letters could be clearer. We issued a report in 2019 on those issues. The agencies have taken steps to address the lack of clarity that they do provide to the banks in their supervisory letters or records of examination.
So, Mr. Clements, if the banks had adequate information on what the problems were and how to fix them for 5 years, what were the reasons they offered for not being able to correct the problems in that time period?
We've, in our past work, have seen a couple of issues. In some instances, the bank will disagree with the finding, and in fact, in the case of Signature Bank, I think there were a few instances where it did not agree with the supervisor's thoughts on where there were problems. In other instances, the bank simply is unable to fix the problems, and we certainly saw in the case of SVB, it agreed with the findings, but they were simply taking them a longer time than needed to get the problems fixed. And obviously, in the interim, the bank failed.
Could you explain a little bit further the excuse that the banks were unable to fix the problem? For example?
In a number of instances, the bank would agree with the problem being cited, but it would simply say it's going to take a while to fix the underlying problem. And in fact, in the case of SVB and the San Francisco Fed, they agreed that it was going to take a while to fix the problem. Unfortunately, the problem got large enough where the bank failed before the problem could get resolved.
Let me just raise a question with you that I really need to understand further. The balance sheet. Does the balance sheet reflect liquidity, and do they have the responsibility to report the securities that they have and the value and whether the value has changed? And someone said to me for the regionals, it's just a footnote. Can you explain that?
A bank of the size of both SVB and Signature, they are required to mark securities that are considered available for sale, mark those to the market value. Any changes to that value is accounted through it's an account called accumulated other comprehensive income is where it would be recorded. So it is being recorded. If the securities are held not for sale, then those securities are not marked to the market.
Have there been recommendations about how the balance sheet should reflect the value of those securities?
I'm not aware. In our past work, we have recommended or reported that it's important to have an accurate accounting of the bank's financial condition to be able to have a good sense of its vulnerabilities.
Thank you very much. I yield back.
The gentlelady's time has expired. The gentleman from Texas, Mr. Sessions, is recognized for 5 minutes.
Mr. Chairman, thank you very much. Director, I'd like to continue down the line that the ranking member was coming down, and I've got the report in front of me here, and yet it provides me, I'm sure other people here, a lot of intrinsic information, but it talks about the amount of outstanding shares of advances under the program in April 19th, 2023 were approximately $74 billion. Outstanding advances. Does that mean that they put all this excessive money that they had into a longer term, something that would generate money to them, perhaps interest? Is that what you're in reference to, outstanding advances under the program? It's at the bottom of page, I think the first page that I've got here. It says, as of April 19th, 2023, outstanding advances under the program were approximately $74 billion. Can you describe that to me?
Sure. So that is the Federal Reserve's term funding program. So at the point when SVB and Signature were failing, the Treasury made the systemic risk determination, which essentially allowed the coverage of uninsured and insured deposits at the two banks. The Federal Reserve also set up this term funding program. The purpose of the program is to allow banks that perhaps would be experiencing liquidity problems to borrow money from the Fed, the collateral being the securities that they're holding, which would be treasuries and mortgage-backed agency securities.
I'm going to keep going here. Maybe I'll catch up with myself at some point, but they took in an excessive amount of money. What did they do with those uninsured risks that is talked about here? Where were they holding that money? Were they loaning it back out? Was it unavailable at the time that someone would need the money to be available when they wrote checks? What did they do with all this money that came in?
So I think there's two separable issues. So there's this issue of the Fed program, the $79 billion, which is lending to existing non-failed banks just to help cover their liquidity.
Whose money was that?
This is the Fed's.
The Fed's money. But what about all this money that SVB brought in? What did they do with that large amount of money that was called an uninsured risk?
Correct. So in the period of 2018 through mid-2022, SVB grew rapidly. And it grew rapidly through uninsured deposits, principally from venture capital-backed firms.
Right.
It used those funds to purchase what, in theory, would be safe securities.
Long-term
Treasuries, mortgage-backed securities, agency securities.
And so then they marked those that they were going to, over the long run, be getting back money. And then they got pulled out early to where there was an unrealized.
Correct. So they held those securities. Unfortunately, they had invested in longer-term securities, hadn't hedged the securities, and when the interest rates started going up, the value of those securities dropped. About the same time, in the venture capital tech industry, they started pulling their deposits because they were no longer getting a bunch of funding.
They maybe pulled them out.
The deposit base started falling. The bank eventually needed to start selling those securities.
Right.
And it was selling them at a loss at some point. And depositors and other investors got spooked.
Of what it would have expected to have received.
Correct.
Are you saying they lost money or did not realize what they thought they were going to get, and so they booked it as a loss?
They lost money because the value of the securities had dropped as the interest rates were increasing.
Money.
Yes.
Okay. I'm clear. This is what I thought coming into this, but I did not understand that most of this, and we at my time, Chairman. Okay.
It is. You can complete your thought.
Well, my point is.
We'll have a light gavel today.
And thank you, because I want to get, and I think the ranking member want to get to this. Who was that held by? Treasury? Most of these?
The securities,
assets?
the securities were held by the bank, by SVB.
Right.
So again, it took in money in deposits, invested that money in long-dated treasuries and other securities. When the deposits started falling because the tech firms needed the money for payroll and whatever, the bank needed to sell the securities, sold them at a loss.
I got it. That's what I thought happened too, but you connected for me.
Yes.
Mr. Chairman,
All right.
thank you very much.
Thank you, and we'll be mindful of the time on both sides. So with that, it's my understanding we're going to Ms. Williams. Okay, that's not the list that I had in front of me. So, all right, Mr. Horsford, you are up for 5 minutes.
Thank you, Mr. Chairman, and to the ranking member of the subcommittee and the ranking member of the full committee. And thank you to Director Clements for taking the time to discuss this important report and the GAO's nonpartisan work, which is crucial to our ability to know what occurred during the rapid collapse of Silicon Valley and Signature Banks and now others that have followed. And while this may be only a preliminary report, the insights provided point to a serious deficiencies with both supervisory practices as well as management's reaction to glaring issues. Actually, it would be more fitting to describe it as management's inaction to the warning signs that were flashing when it came to even the most rudimentary risk management. And I really want to point out that reality right now in this moment, dealing with the default on America, that my colleagues on the other side are failing to acknowledge, and their role in basic rudimentary risk management against an economic collapse that none of us can even imagine. According to the White House, in the event of a default because of our colleagues on the other side's unwillingness to raise the debt limit, quote, a crisis characterized by spiking interest rates and plunging equity prices, including home equity, would be ignited. Short-term funding markets, which are vital for the liquidity backing long-term mortgages, would likely shut down completely. There would be a rapid and complete tightening of credit at regional and community banks who would no longer be able to accurately price their treasury bills or use them as high-quality collateral. Since these banks do the bulk of mortgage lending, the mortgage rates would go through the roof. That is the management decision of the House of Representatives in this moment. We are standing here as the board of directors for the people of America, whose mortgages, whose car loans, whose financing ability is being jeopardized because of Kevin McCarthy and the default on America proposal that is holding America ransom in paying its bills. Excuse me, I have the order.
There's parliamentary inquiry, which is appropriate.
The gentleman needs to make his remarks to the chair, not individuals.
The chair.
That has nothing to do with this
There was
committee.
just a moment. The chair did not hear a reference
I
to
reclaim
another
my
member.
time. I
Just a
reclaim
moment.
my time.
Just a moment. That there was not a reference to another member. It was not that. He was talking about the speaker. So the chair does not see the problem. By name, correct. So it's noted, and the gentleman may continue.
Clearly, I've hit a nerve because this is about the American people, their finances, which are being held hostage because of a ransom note that is being offered by Kevin McCarthy and the default on America proposal that they've made, rather than our obligation to raise the debt limit and to pay the bills that have already been incurred by the prior administration and prior Congresses. So I think that while we do our jobs in examining Silicon Valley Bank and Signature Bank and First Republic Bank, we should actually do our job as Congress and avoid this major catastrophe that is weeks away, and we know it. We have a responsibility to manage risk as Congress, and we're failing to do our jobs. No, let me make it clear. Republicans are failing to do their job. So I'm asking that we use the time of our committees to focus on the crisis that's right in front of us. And if my constituents, small businesses, people who have mortgages, families who are worried about meeting their obligations, are going to be impacted by higher interest rates because of Congress's inability to do its job, then we should be discussing that at this time. Now, Mr. Director, you primarily focus on the failure of regulators to adequately escalate their supervisory concerns. And we certainly have some work to do bolstering supervisory escalation. However, I found the sections in the report focused on management's unwillingness to address repeated shortcomings just as alarming. For example, if Silicon Valley Bank's board, which I would say is the Congress right now, is unwilling or unable to, as you say, quote, provide effective oversight of implementation of the risk management framework, unquote, then what is the use of the framework in the first place? You go on to say that the behavior of these executives and board members was irresponsible at best, as they let multiple supervisory letters fall on deaf ears, as we're hearing from economists tell us today. Specifically for Silicon Valley, I'm particularly, the other side went for more than a minute the last time. I'm just
The
using
chair
an
is very
equal
aware
amount
of the
time.
timing. I'm giving you a tap of wrapping it up.
If the Federal Reserve is correct in their report statement that Silicon Valley Bank's management was focused on the short-run impact of profits, in this report, it is mentioned that Silicon Valley Bank did take steps to revise its incentive compensation
Your minute
programs,
is up.
but evidently
The
they
gentleman will
failed to do
suspend.
so.
If we're going to play that game, we'll play that game. So, the gentlelady from...
The only game being played is by the
gentleman
other
is out
side
of
failing to
order.
do its job.
The gentleman is out of order.
I don't mind
And
being out of order
the
for the
gentleman
American
will
people.
suspend. The chair will not accept this behavior. I let a line of questioning go for an answer that was along the line of the ranking member. I then allowed you to have a full minute, which was not what my colleague from Texas got. So I expect that we are going to behave like adults at this table as you are, just a moment, as you are demanding that Congress act. So lead by example, everybody.
Parliamentary
With that-
inquiry.
Yes, ma'am.
Parliamentary inquiry. Are you going to afford to every member of the committee an additional minute?
No, I will not be. We will be adhering to the exact 5 minutes from now on. It has been even on both sides.
Mr. Chair,
Everyone is.
I would caution you not to
the-
imply
the
that
ranking
our
member is-
members are not acting like adults.
the
I don't
the
think
ranking member-
that is a
I'm-
credible statement.
The ranking member will suspend. That comment was to all sides and to everybody watching as we are on television. Let's present to the American people that we can actually act like adults at this table. Everyone.
I think we are, and we don't need you to admonish us.
Thank you for your commentary,
Thank
ranking
you.
member. And with that, the gentlelady from Missouri, 5 minutes.
Thank you, Mr. Chairman. And I would remind my good friend from Nevada, Mr. Horsford, that the only body in Congress or the administration that has passed a debt ceiling are the Republicans in the United States House of Representatives weeks ago. We have waited over 100 days to hear from the White House regarding the very important issue of the debt limit and reining in out of control spending, which frankly has driven inflation, which drove interest rates, that drove us to some of the banking volatility that we're seeing currently right now. So I would remind us all once again that it is Republican House that passed a debt ceiling. Thank you very much. Now, Mr. McClements, I want to thank you for appearing before us today and certainly for GAO's very quick work in preparing this thorough and independent report on the March 2023 bank failures. Over the past 2 months, this committee has gathered more information about the management failures within these banks and the blatant lack of urgency for many years by federal regulators to act more forcefully in preventing these failures. I am committed to investigating and holding accountable those who were asleep at the wheel once again and allowed these preventable failures to occur. Mr. Clements, on page 23 of your report, you note that the Federal Reserve Bank of San Francisco did not recommend the issuance of a single enforcement action against SVB despite the bank's serious liquidity and management issues. On March 29th, Vice Chair Barr stated that there were 7 supervisory determinations raised, but we've now come to learn that since 2018, there were actually 15 related liquidity and risk management issued. After 15 MRAs and MRIAs, matters requiring attention and matters requiring immediate attention have been issued, did you agree that escalating supervisory actions should have happened sooner, sir?
Yes.
Thank you. What is the GAO's perspective when it comes to this slow-to-act pattern we're seeing from federal regulators?
Again, this has been a pattern going back to 91. Following the financial crisis in 2011, we had similar findings. We have in the past have recommended trigger mechanisms. For example, if a particular measure is hit, or if there's multiple instances of not resolving a problem, that would force
Yes, thank
an
you.
escalation.
Enforcement must happen after so many citations have been given out year after year after year after year. What, Mr. Clemens, in your work, did the GAO see a notable shift in how SVB was supervised, particularly as it rapidly grew in size from a bank of approximately $71 billion in assets in 2019 to over $200 billion in 2022? What were those differences?
There was a shift. So under $100 billion, SVB was overseen by the regional bank organization at the Fed. Once it passed over that threshold, then it moved to the large and foreign bank organization. At that point, the number of examiners expanded rapidly. I think it got up to around 20 examiners looking at the bank, doing very target exams.
But these liquidity and risk management citations that were issued went all the way back to 2018, sir.
That is correct.
Okay. In the report, the Fed cited that the pandemic as one of the factors explaining why the agency failed to properly supervise SVB. Yet, according to the Fed's November 2020 Supervision and Regulation Report, and I quote, reduced examination activity only lasted for 3 months, from late March to mid-June, with the greatest reduction occurring at the smallest banks. Do you think the 3-month pause was a significant contributor to the Fed's challenges in escalating SVB's known supervisory issues?
I think the pause is separable from the decision to escalate. There were a number of warning signs along the way. Clearly, there was the combination of the pandemic and their switch between regulatory divisions caused.
3 months only, and mainly the smallest banks. I have a couple more questions, Mr. Clement, but I'm going to adhere to the clock and decorum, and I will yield back the rest of my time, Mr. Chairman, and I thank you.
Gentlelady yields back. The gentlewoman from Georgia, Ms. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman. In our full committee hearing on the failures of Silicon Valley Bank and Signature Bank on March 29th, I reminded everyone listening of the regular, hardworking people who are impacted by these failures. I want to continue to center these same people that these failures of SVB, Signature Bank, and now First Republic Bank have affected. As the Congresswoman for Atlanta, the city with the largest racial wealth gap in the country, I'm focused on how we can prevent future bank failures that disproportionately impact marginalized communities. We have regulators, the OCC, the Fed, and the FDIC to monitor banks' behavior and practices and ensure repeat offenders correct their bad behavior. Regulators repeatedly warned SVB and Signature Bank about their weak risk management and liquidity issues. In fact, regulators identified numerous matters requiring attention and matters requiring immediate attention regarding the liquidity and risk management of SVB and Signature Bank. These warnings were not sufficiently acted upon, and as a result, many small business owners, including Black entrepreneurs from Atlanta, were faced with the possibility of not being able to make payroll. If entrepreneurs of color can't trust the bank regulators are taking serious action to ensure that their banks are safe, then how are they supposed to build their businesses and create wealth in communities like Atlanta? Mr. Clements, how can regulators ensure matters requiring attention and matters requiring immediate attention are appropriately addressed by banks?
Yes, I think that goes back to our prior recommendations to have some type of trigger mechanism. the regulators currently operate on a more informal basis, trying to get a collaborative solution. It's been our recommendations in 91 and then again 2011 to have some type of trigger mechanism that if the problem is serious enough or if there are multiple instances where the problem is not getting resolved, that it would automatically require enforcement action.
How does that impact the escalation framework? How can regulators improve their escalation framework for regional banks?
Again, I think it takes some of the discretion away from the regulator by requiring particular enforcement action if a particular trigger has been met.
And how could those improvements be applied or adapted and then applied to larger banks, especially the banks considered too big to fail?
In our work, I think we would apply those standards throughout, having a trigger, again, if particular conditions are met that would require either an informal or formal enforcement action or other escalations of supervisory actions.
GAO's preliminary review states that in the years prior to 2023, the Federal Reserve and the FDIC identified what turned out to be key drivers of bank failures: liquidity and management risk. However, according to GAO, neither regulator's actions resulted in the bank's management sufficiently mitigating the risk that contributed to the bank's failures. Mr. Clements, based on the GAO's review, can we determine who is at fault here? I see three potential options, and I would like your thoughts on which is the most accurate portrayal of fault. Was it the inability of the banks to mitigate risk due to the failure of regulatory agency officials to adopt examiner recommendations for corrective actions? Was it banks' failure to effectively institute the corrective actions directed by the agencies? Or was it the banks' failure to effectively institute the corrective actions directed by the agencies, combined with the agency's failure to take strong action when banks' responses were insufficient?
At the end of the day, it's the bank's responsibility to manage the organization in a safe and sound manner. At the same time, we would expect that if a supervisor is seeing problems that they're repetitive, that more forceful action would be taken.
So as we sit here less than 2 weeks after the failure of the First Republic Bank and 2 months after the failures of SVB and Signature, the second, third, and fourth largest bank failures in the country's history, I'm concerned about the possibility of yet another bank failure that would impact my constituents, one that could have even more disastrous effects. I would like you to speak to what Congress should take away from the GAO preliminary report.
At the end of the day, it's banks' responsibility to manage the organization. However, we think if there are repeated problems or serious problems that the regulators need to take more forceful and early action before the problems become too large to get resolved. And in fact, when we were talking with the San Francisco Fed officials and they described the liquidity at SVB, and they said it was going to take a while for SVB to fix the problem because it was so big. The natural question you ask yourself is, why did it become so big?
Mr. Chairman, my time has expired, but I have many more questions that I would like to submit to you later to get answers with.
The gentlelady is allowed to do so. With that, the gentleman from Tennessee, the vice chair of this subcommittee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman and Ranking Member Green, for holding this hearing, and obviously an important topic. I want to dive right in. Director Clements, and am I saying that right?
That's correct.
Okay. In response to a question from Chairman Huizinga earlier, you mentioned that there were multiple people in the interviews between the GAO, the FDIC, and Fed staff. Director Clements, were staff conferring with counsel during these interviews?
There's traditionally the agencies would have their general counsel office there.
So they were conferring during these particular interviews?
The staff spoke freely to us, but it is fairly common for somebody from the legal division to be present at these meetings.
All right, thank you. Derek,
not simply these meetings, but in general.
First Citizens Bank's stock has nearly doubled since acquiring Silicon Valley Bank, but the FDIC capped its potential gain on First Citizens stock at $500 million, which to me seems like the FDIC got a raw deal for us. My concern is that sweetheart deals like this actually encourage acquiring banks to wait until the FDIC takes over a bank before making a bid because they can get a better deal once they are in conservatorship. why buy the cow when the milk is free, so to speak. So Director Clements, did GAO review the terms of the offers that were submitted to the FDIC?
We did not have time to get to that level of detail. I do know that in the request from the committee, there is interest in those topics.
Going forward, would you commit to reviewing that issue, these issues of offers that are considered but not accepted?
I think, and again, we're working with the staff to sequence, with the committee staff to sequence our range of work, so that's certainly something we can consider.
All right. The FDIC and the Federal Reserve staff told the GAO that as SVB and Signature Bank failed, they conducted analyses and worked closely together, including exchanging drafts of the recommendations to invoke the systemic risk exception for the two banks. Do you have any insight into how many drafts of the recommendations there were to invoke the systemic risk exception?
I do not. We saw the final letters that were sent along with some preliminary analysis that the agencies had conducted.
The GAO report notes that Treasury staff consulted regularly with the FDIC and Federal Reserve and concurred with the basis of their recommendations to invoke the systemic risk exception. Could you please provide some specifics on what this consultation actually looked like?
I don't have the specific details on that. You know, they certainly told us that there was conversations between the three agencies over that weekend as each were doing their own analyses.
Thank you. The GAO report notes that you were being you will be moving forward with more work on this issue as we move throughout the year. As I'm sure you're aware, in the United States, we have a Financial Stability Oversight Council, which is charged by statute with identifying risk to the financial stability of the United States, promoting market discipline, and responding to emerging threats to the stability of the U.S. financial system. It seems to me the FSOC was asleep at the switch here and was instead busy studying the weather when they should have been concerned with interest rate risks. So, Director Clements, would the GAO commit to conducting a review of FSOC's actions during these bank failures?
We actually currently have ongoing work looking at FSOC. And I'm aware that in its most recent annual report, it did have a recommendation pertaining to interest rate risk. But you may know that the recommendations that FSOC makes are non-binding.
I hope you do continue to look at that. Some have argued that Signature Bank's involvement with digital asset customers somehow contributed to its subsequent failure. There also appear to be competing views from the FDIC and the New York Department of Financial Services in their recent reports about the role digital assets played in Signature's failure. Did GAO review whether Signature Bank's customer base contributed to its failure?
We looked at the supervisory letters and records of examinations. We certainly saw instances where there were large deposits from the digital asset space, but again, it was simply holding the deposits in operating accounts for those entities. Following some of the turmoil in 2022, in particular FTX, some of those deposits did start
Gentleman's
falling
time
off.
has
I
expired.
hope you will dig into that issue. Thank you, and I yield back.
Gentleman's time has expired. The Congresswoman from Michigan, Ms. Tlaib, is up for 5 minutes.
Thank you so much, Chairman. Thank you, Director Clements, for this report to really kind of dig deeper into this. I think I get a lot of questions regarding the lack of transparency of fully understanding this. Did you look at the timeline of some of the compensation and payouts and things like that that led up to the failure?
We haven't got to that. We do know that again,
Is that something that you would look into?
It's one of the requests that's in the letter that we received from the chair and ranking member Waters.
That would be wonderful. You know, one of the things my good colleague was talking about is regarding regulators, and you said it's not binding. I mean, could they, because they haven't, when was the first time they said, yo, something's going on? The regulators are like, you know, could you call us back? Can you respond? Or something's going on. What year was that?
The first instance that FSOC brought up the interest rate risk was its most recent annual report, which would have come out early this year.
And so they sent a letter, they tell them whatever. I mean, can they go arrest them? Can they fine them? What can they do to make them respond?
The recommendations in the annual report are non-binding.
Yep.
It can also do what are called Section 120 recommendations, but again, those are also non-binding.
So when you do look at the timeline, because I don't know if you can answer to this question, like why did the banks take on the risks and ignore repeated warnings? Why? Why ignore the federal government and their warnings?
Yeah, I don't,
Yeah.
don't have a good answer to
Well,
that.
I think bankers know how to manage risks. They're not stupid. I just think they're greedy. And so, you know, senior employees promoted unsound practices, ignored risks because they stood to benefit from it. Look at the timeline, Director, when you do this next follow-up report. SVB offered some of the most generous compensation packages around. Look at it. Compare it to other banks. In 2022, the CEO, Greg Becker's salary is roughly $1 million, but he enjoyed over $5 million in stock awards last year and $2 million in stock options. Becker also earned over $6 million since 2020 from an incentive compensation plan on SVB's net income, even when the warnings were coming in. This helps explain to me why during 2022, SVB terminated close to $15 billion in interest rate swaps that hedge against the impact of rising rates. The same bank started in 2023 almost completely unhinged because for senior employees, higher net income meant higher compensation, correct?
I'm not familiar with their arrangements. Again, that'd be something we can look at.
You need to look at how the timeline is critically important because you can see how it led up, but they still got benefits. They still won, even though, again, this is impacting now other banks and really people to payroll, small businesses, and so forth. Last year, you know, the Signature Bank CEO, Joe, is it DiPaolo, is that how you say it, received over $8 million in total compensation, Director Clements. I mean, Mr. Clements, do you think that compensation incentives contributed to the poor risk management by the banks?
I don't have a basis at this point.
I know
to
you
say
can't.
that.
I just really love to ask that question. I think in the report, you know, one of the things in Dodd-Frank, and it's something that, you know, our committee has been wonderfully educating me on, but the Section 956, it's been, 12 years, they haven't implemented it. Can you, as in your role, Director, look at the impact of not implementing the Section 956 of the Dodd-Frank Act?
We can certainly take a look at those.
Yeah,
issues.
I mean, this is really important because we need teeth. We need enforcement. We need to be able to claw back. We need to be able to, again, hold them accountable because they're just not going to respond. There's nothing we can do. I mean, they're just going to ignore us so they can set it up so they can benefit from it over and over again. One of the things that I think, American people do fully understand is, we as a role of oversight is that we can call it out and do, basically expose the greed. But unless we give the authority and kind of the force and the binding force for our regulators to do something about it when folks unrespond, other banks are going to do the same. They're just not going to respond to us. They're just going to continue doing this, kind of really crooked, very criminal-like actually, set up so they can benefit and get more compensation. My God, they sold the stock when they knew it was false. I mean, they knew and never informed it. To pick up the phone and tell us, hey, sorry, tomorrow we're closing shop? Ta-da! Why isn't anybody more mad at the banks? They literally just ignored the American people when they ignored the regulators. Thank you, I yield.
General A's time has expired. The gentleman from Pennsylvania, Mr. Muser, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Clements, you are the Director of GAO's Financial Markets Community Investment Team. I want to just ask you first a couple of quick questions. In 2021, 2022, this Congress overspent by over $5 trillion with policies that caused huge spikes in energy, causing high levels of inflation, and which in turn we got much higher interest rates escalation, rattling the economy, crushing pension funds and disposable income. Do you think the American people trust Congress with a blank check moving forward, particularly when it's the American people who have to pay the bills?
I don't think I'm qualified, honestly, to answer and to direct those
All right,
questions.
thank you. So according to a report, the SVB was downgraded in June 30th, 2022 by the Federal Reserve of San Francisco due to concerns about its liquidity risk management from 22 May review. Your report states the Federal Reserve's board team was still working on how to address this issue when SVB failed in March of 2023. Isn't it true that the regulators have discretion for oversight on such banks regardless of the S2155 set thresholds? If there are red flags, they've got all kinds of discretion.
The regulators have options to do supervisory letters, recommendations, informal and formal enforcement actions, including civil monetary penalties.
Okay, so blaming it on S2155 would head us down the wrong direction. We'd never actually solve the problem or uncover where the problems occurred.
The agencies have plenty of authorities now. We do know that the committee has asked us to look at the enhanced prudential standards, so I think I don't want to prejudge where we might come on
All right,
that.
thank you. GAO also points out in its report that the San Francisco Fed gave SVB a 7-month extension to address a November 2021 deficiency. A key finding from the report was that the regulators did not escalate supervisory actions to mitigate key risks associated with the bank failure. Specifically, you state that the San Fran Fed lacked urgency. The San Fran Fed did not recommend the issuance of a single enforcement action despite the bank's serious liquidity and management issues before the bank's failure. Why do you think that is?
Again, I think this has been a repetitive problem going back to the 90s, the early 2000s, and now the regulators in general favor an informal, cooperative process. It also is a little challenging if a bank is profitable, has adequate capital, to then suggest to the bank it needs to stop behaviors that the regulator thinks are potentially risky. So there's a variety of issues that could affect it. But again, I think we looked at this environment and saw numerous instances where escalation probably was warranted.
So, but your report does say the supervisory teams blame tailoring reform under S2155 for these failures. We know that the Fed and the FDIC have discretion, regardless of those thresholds as earlier mentioned, to address, investigate, perceive potential or discovered problems. Why didn't they? And why would they blame on something that really didn't stand in the way in the first place?
And I think it's this standard, what we've seen in the past, which is a hesitancy to take more aggressive actions.
Let me ask you this. In general, do you think community banks are much better managed than these outliers that have failed?
I don't think I have any basis to talk about the distinction between the banks. We can go back to the 90s, and it was a number of the smaller banks failed.
No, I'm talking about now, and I believe they are, based upon my research and knowledge and discussions and financial discussions with community banks. You don't feel that the community banks would be better managed than these banks that have failed, SVB and First Republic and Signature?
Well, in the case of the two banks, they're obviously better managed than the two that failed.
What about
by
regional
default.
banks? You think they're managed better?
We've not done work for me to be able to opine on their management.
Okay. Well, state of affairs then. Do you find it to be, these banks have been rattled by all of this bailout that occurred with SVB, and now community banks are concerned that they may bear the brunt in higher FDIC fees. So that's unnerving some of their depositors. Do you think that's undue, unnecessary, or what's your thought?
Gentleman's time has expired.
I yield back, Mr. Chairman. Thank you.
And you'll be able to answer that question in writing. With that, the Congresswoman from Texas, Ms. Garcia, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Clements, for being here with us today. I wanted to also lay out a few facts before I begin. And the first one is that the president has lowered the deficit by $1.7 trillion, $1.7 trillion in his first 2 years in office. So we really, when we talk about the debt ceiling and we look at everything, we really need to get some facts out. This president has made it clear that defaulting on the debt is not an option. The statement made earlier that Republicans are the only ones who have passed anything is probably true. But what's not said is that it's not a clean debt ceiling raising. It comes with cuts that are so deep that they would impact Social Security, they would impact Medicaid, it would impact our veterans, teachers, it would create more job losses. So that's the reason many of us cannot support that. Always there has been a raise of the debt ceiling, hundreds of times. In fact, every year since World War II, it's been raised. Only because it's this president and this year do we see so many concerns about making cuts before or doing it together. We don't have any problems with making some cuts. They just should not be tied to raising of the debt ceiling. It should be a debt ceiling that's clean, one that has been done so many times before, including for the former twice impeached president. Many of the people talking about this issue now did that last time. So where were they then making some of these comments? Secondly, I'm glad that we're doing this hearing, but I wonder, Mr. Chair, when we're going to really focus on the root causes of what caused some of these failures, and when we're going to look at comprehensive legislation and responsible governance. Because as I've reviewed some of these items, it appears to me that I agree with others that have already said it here at the table, that this was about governance, it was about management, it was about failing to minimize risks. And I was particularly drawn to the response that you gave the ranking chair when she asked you about some of the reviews that are done by the examiners, and you said that many of them, that y'all were told that, quote, it would take a while to fix the problem. Since when has taking a while to fix a problem been acceptable when someone does an audit? You know, I was city controller of Houston. I oversaw a $2.3 billion budget. We did audits. If somebody told us, oh, well, it's going to take us a while to fix the problem, first thing we'd say is, what is your timeline for getting it fixed? So did we see any of that, or did the examiners just kind of go like, oh, okay, fine, y'all fix it?
Yeah, so that occurred in the 2022 timeframe. As I think we mentioned in the report, starting in August, the San Francisco Fed and the Fed itself.
But let's get to my question, sir. Were they given a timeline and when they needed to, submit a management response, take corrective action, we're going to be back, or examiners back, to make sure that they did what they promised to do, or was it just let go?
In many instances, the supervisory letters did detail what needed to be done and the timeframes. But again, for some of these larger issues, it appeared that the dates were allowed to slip.
Things were allowed to slip. Well, then that is part of the root of the problem, isn't it? If things were allowed to slip. Can you give us an example of what was so major that they couldn't do immediately and take corrective action that would take time, quote unquote, to fix a problem?
The concern was principally about the liquidity and its the governance of the liquidity and the liquidity controls at SVB.
So they didn't have investment review committees or investment team that really looked at that?
There were numerous failures in its internal liquidity stress testing, and the Fed was looking for solutions to those problems.
Right. And let me ask you, because there's been a lot of focus on the federal examiners, what about the state examiners? What responsibility do they have in this whole scheme?
There's a mix depending upon the signature and SVB are a little different because they're dealing with different states and how they manage that relationship. For the most part, the federal regulators were the ones in charge.
Gentlelady's time
Thank you.
has
I yield
expired. The gentleman from Tennessee, Mr. Ogles, is recognized for 5 minutes.
Thank you, Mr. Chairman, and if I may, I would like to correct the record. I think my colleague had inadvertently mischaracterized some things that were taking place. As far as the debt ceiling goes, there is no intent to impact Social Security or Medicare, and nor are we going to impact our veterans. In fact, if you go back to 2011, our current president, in his own words, stated that compromise was part of the process. In fact, said it was the normal political order of things to do so. So just for the record, Mr. Chairman, I did want to just set the record straight. You know, I know we've talked a lot about this, and I don't want to beat a dead horse. And we do have the benefit of kind of after action or the rearview mirror approach. But as you look at some of the high marks, the satisfactory marks that were given to SVB, you mentioned the hesitancy and the difficulty it is for the regulator to step in, if you will. But in part, isn't that their job?
It is the purpose of supervision and regulation to ensure that banks operate in a safe and sound manner.
So as we look forward, and keep in mind that, you know, the small and mid-sized banks, there's roughly 4,700 doing it right, you know, so, you know, we don't want to target an industry because of a few bad actors. But how do we fix the process and the culture that seems to have crept into the regulatory structures that are, quite frankly, preventing them from doing their job in a timely fashion?
And I think that's where we think triggers come into play, that if a particular measure exceeds a threshold, or in these cases where there's been MRIs, MRBAs in multiple times, that triggers an action, that the regulator would then be required to take action rather than continuing to wait and trying to work through a problem.
And again, I'm not going to ask you to second guess the regulators in these specific instances, but when you look back, you know, all the way going back to, you know, for SVB 2018, there were clear signals and signs that there was a problem, but yet fast forward 4 years later, nothing was happening in a timely fashion. What would be, is you, again, if you were to lay out a roadmap of how do we improve the process, what timelines might you map out for the regulators to say, here's a problem, yes, they're profitable, however, you have increased liquidity risk, yes, you're profitable, however, you know, you have this flight risk as you move forward. What would you see those triggers looking like?
In the past, we've recommended that the regulators and industry work together to find out what would be the best practices to ensure that there's adequate action, but you don't want action for a bank that is healthy, right, and that the regulator thinks, well, perhaps a problem will occur, because then you end up imposing unnecessary cost and burdens on that institution. So the regulators and industry working together to come up with adequate measures and benchmarks.
Well, you know, and I want to be clear, you know, I've said it once, I'll say it again. Ronald Reagan said the scariest phrase in the American language, and I'll paraphrase, is, I'm from the government and I'm here to help. And I think as we move forward, we've got to be cautious in reaching too far in this process. But I do look at the regulatory regimes in both California and New York and see a systemic failure on their part to take action. I mean, when you look at, again, the timeline of when the draft is taking place in the previous year, and 6 months later, the draft is still being drafted, and then meanwhile, SVB collapses. I mean, is that acceptable on part of the regulators to take 6 months to draft a letter? I mean, I'm no Shakespeare, but I can write a letter in a more timely fashion than 6 months, even if I'm having to research data points.
I think we had a concern again. That's why we talked about a lack of urgency and timely action in that case. Obviously, going from August 2022, I guess the argument was they needed to collect additional information, but it did seem to us that there were enough instances of these MRIs and MRAs finding those problems that they could have moved forward with more urgency.
My last 30 seconds, is there anything in the regulatory regime that would have prevented the regulators from doing their job?
The regulators have authority to make recommendations, informal and informal enforcement actions, again, up to including civil monetary penalties.
Yes, sir. Mr. Chairman, I yield back.
Gentleman yields back. With that, the ranking member of this subcommittee, the gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Director, you're not here to tell us that the banks are not responsible, are you?
The banks are, bank management is responsible for operating
The bank management.
in a safe and sound manner.
Yes. And you are here to tell us that these bank managers mismanaged the bank's business. Is that a fair statement?
The record we saw were numerous instances of at least the liquidity and risk management problems that had been identified going back to 2018.
Well,
with
you
these
said that the
institutions.
regulators were calling things to their attention that you thought should have been dealt with, and you've indicated as much. Do you now say that the banks did not have the responsibility to make these changes themselves?
The banks are responsible to resolving the problems that the supervisor has identified. Our concern, and that's the bank side, the
Yes.
supervisory
But-
concern is
well, we're talking
when nothing
about-
happens.
Excuse me, let's talk about the bank side for just a moment, if
Okay.
you would, please. You also have indicated that the agency has plenty of authority, and then you went on to say, but you didn't want to prejudge, you'd like to have an opportunity to review. Is that a fair statement?
Correct.
Excuse me if I may. I just needed to know if that was a fair statement. Now, knowing this, that it doesn't have, that it has plenty of authority, you're not saying that they have enough authority, are you? Because enough would mean that you wouldn't have the time to review.
The committee's request is for us to look at enhanced prudential standards, and
I
we intend
understand.
to do that.
Well, are you saying that the regulators have enough authority and that nothing more should be done?
I'm not in a position right now to judge whether
So
they
you're
have
not
enough.
saying that, are you? You're not saying, are you saying that?
I'm saying they have authorities.
They have authority, but you're not saying they have enough authority, are you?
I think we would need to do additional work in that space.
So to determine.
Correct.
So today you're not saying they have enough authority, are you?
We're saying they have authorities. We need.
But they don't have enough.
We need to conduct.
You don't
additional
know
work.
that they have enough.
I can't at this point say that they have enough.
Oh,
or
that's
too
fair
much.
enough. You can't at this point say that they have enough. And it's important for you to say this, Mr. Director, because the other side is making the case for enough authority. They're making the case for the status quo. They're making the case for banks to be able to do what Silicon Valley did. We're making the case for doing something that can have an impact on the people who have the responsibility to manage the depositors' money. They're not. Now, Mr. Director, is it true that the stress test can have an impact on the decisions that regulators make? Once they review it, if it's an adverse conclusion, can it have an impact on their decisions?
It is a factor in the supervision of organizations.
So it can have an impact on what they think, can it not?
It
Are
can-
you shy about saying that an adverse stress test will have an impact on the decisions of regulators, Mr. Director?
The supervisory tests are an important element.
I understand, but let's talk about the stress test.
Correct. Yes.
Okay, thank you.
It is.
And the stress test wasn't scheduled until, because of changes, the stress test was scheduled for 2024 for Silicon Valley Bank. Let me use my last 48 seconds to say this. I want to commend all of the members for their questions, but I want to commend especially the members on this side and those that decided to talk about the preeminent issue facing this Congress, which is, are we going to allow a default? I commend them for bringing it up. It's not unusual for us to bring up issues that relate to the business of the Congress, but not necessarily relate to the business of a given hearing. And I thank Mr. Horsford for what he did. He is upset because we may be facing a default that may cause a collapse of our economy. I yield back.
Gentlemen's time has expired, and in accordance with committee rules, we do allow subcommittee members to waive on for questioning, and we will be doing so with a gentleman from Kentucky, Mr. Barr, who is also the chairman of the Subcommittee on Financial Institutions. So with that, the gentleman from Kentucky has 5 minutes.
Mr. Chairman, thank you. Thanks for allowing me to waive on. I want to start off by thanking the GAO, Mr. Clements, and your team for putting out a timely, nonpartisan, apolitical report that is external to the self-assessments we've seen from the Fed and the FDIC that don't give a complete narrative. And I think
Mr. Barr, Mr. Barr, sorry to interrupt, but if you would pull that closer. Thank you.
To finish the point, I think it's vital that we have an unbiased external report that helps inform the American public and the Congress. I also want to thank my good friend, Mr. Green, and Mr. Horsford for raising the important preeminent issue facing the Congress, and that is raising the debt limit and avoiding default. And I would just remind my colleagues that the only institution in government that has actually done that work of raising the debt limit is the Republican majority in the Congress, and every single Democrat member of the House of Representatives voted against raising the debt limit. To get to my questions, in your work in looking at the bank supervisors here, especially the San Francisco Fed, do you see any evidence of concern leading up to Silicon Valley Bank's failure of the large concentration of uninsured deposits in a single sector?
There was concern. We certainly saw concerns raised about.
So there was evidence that they raised that concern.
Correct.
Okay. I believe the Fed report that I've reviewed, their self-assessment, they say in here that Silicon Valley Bank crossed the regional bank organization portfolio to the large foreign bank, not a foreign bank, but the large bank organization portfolio within the Federal Reserve structure in February of 2021. Is that correct? That's what the Fed says.
I don't have the specific dates, but
well, that's what the Fed says.
Yeah.
The Fed says that they crossed that supervisory threshold nearly almost 2 years before the bank's failure.
I think it was certainly the case in our report. I think we might say June, but it's somewhere in the 2021 timeframe.
The Fed says they crossed that threshold February 2021. But then it also says, so in other words, enhanced prudential standards applied to this institution as a large institution, according to the Fed's own determination, 2 years before the bank failed. Is that correct?
It would have been a Category 4 firm at that time.
Right, and that's enhanced prudential standards. Under Dodd-Frank as amended by the bipartisan regulatory relief law of 2018.
Correct. At that point, it is
as
subject
implemented by
to-
the Fed, under the $100 billion threshold.
Correct.
Okay.
And then there's tailoring above that level.
Sure. But in this case, this bank, under Fed regulations implementing Dodd-Frank as amended by the regulatory relief law of 2018, enhanced prudential standards applied to this bank, categorized as a large financial institution as of February 2021. 2 years before the bank failed.
That's correct. In 2021, it got into that group and was subject to large foreign
So
institutions.
the Fed report also says that board, meaning the Federal Reserve Board staff, provided the San Francisco Fed team a waiver to delay initial set of ratings under the LFI, Large Financial Institution Rating System, by 6 months until August 2022. In your investigation, do you have any insight or visibility as to why the board waived that requirement from the?
No, that's additional work we'll need to. Okay.
Yeah, please look into that, because the regulators at the Fed are delaying implementation. They are. The law doesn't say that they have to, but the supervisors, the bank examiners, are delaying implementation of the law that we passed and that we amended in 2018 and that the Fed implemented. So, look, it's on the supervisors. Let me just say this also. According to your report in 2020, the examiners at the Federal Reserve Bank of San Francisco found that SVB was not doing all required liquidity stress testing. Specifically, SVB did not provide liquidity risks for a period of 30 days or less. However, as they were required, but examiners continue to give SVB a satisfactory mark for liquidity and the highest CAMELS rating for liquidity from 2018 to 2022. In your experience, would it be unusual for an examiner to give a bank a high liquidity rating despite some of the required testing not being done?
I think that's the concern we had. We didn't, the high ratings, especially for liquidity, also for management.
Yeah, also, your report describes informal non-public enforcement action that was taken by the Federal Reserve Board staff to address ineffective governance. However, as of March of 2023, and the
time.
failure, the MOU is still in drafting process.
Gentleman's time has expired.
For the gentleman, for the record, maybe, is it typical for an
Expired.
formal enforcement action like this to take more
Expired,
than
Mr.
6
Chair.
months?
The gentleman's time has expired.
It has expired. It has expired.
And
I appreciate your
we will allow you.
Expired.
Excuse me, Ranking Member, I've got it handled.
Yes, well, I
So,
don't know what you do.
the gentleman will suspend. So, gentleman from Kentucky can submit the final thought and final question to the witness for a written response. And I would like to thank our witness for coming in today. And without objection, all members will have 5 legislative days with which to submit additional written questions to the witness through the chair, and that will be forwarded to the witness for a response. We would appreciate your timely response on that, Mr. Clements. And with that, this hearing is adjourned.